Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams. Today, we are running through the capital city market update, the Australian capital cities. We'll go through every capital city, see where they're running at based off historical sales data and the 18-year land cycle. So stay tuned. Firstly, we have the CoreLogic data out for the month of March, which has shown an increase of 0.4% for the Australian CoreLogic dwelling price month on month. So across the whole of Australia, we've had a regain in the slight retracement in the recent months. So we are back in positive territory. If you look at it from a holistic market, but as you know, there's not one Australian property market. It is derived of many sub-markets and suburbs. And this is how each market performed throughout March. We had the leading market being Darwin, up 1%, followed by Adelaide, up 0.8%, Melbourne, up 0.5%, then Brisbane, 0.4%, followed by Sydney at 0.3%. Perth looks to be losing a bit of steam, up 0.2% for March. And Hobart was the only capital city that corrected for the month of March, down 0.4%. So if we look at an annualized measurement for each capital city, we can see Perth in the last 12 months has outperformed the markets with 11.9% increase in the last 12 months, followed by Adelaide up 11%, then Brisbane up 8.6%, followed by Darwin up 2.6% for the last 12 months, then Sydney up 0.9%, so not even 1%, and then Melbourne, Hobart, and Canberra subdued in negative growth over the last 12 months. And now if we look at, which is quite interesting, I believe, the home value index. As you can see, Sydney is on the top of the list with the highest price point for home values at just under 1.2 million, followed by Brisbane, just under 900,000, then followed by Adelaide at 827,000, Perth 806,000. Sorry, Canberra was in there at 854,000. But what I find is the most interesting out of this is Melbourne is currently tracking in 6th place in terms of price point. To me, that is screaming value. Hence why we are mainly focusing on down in that market currently, along with Sydney, certain pockets, because that is where the best value is found. Meanwhile, most of the mainstream are continually pouring into the likes of Brisbane, Perth, Adelaide, but I'll show you in these future slides why we are no longer focusing on those markets. This is, as you are aware, if you've been following me, my 18-year land cycle framework I like to use. Consists of 14 years of expansion, 4 years of downturn, and the mid-cycle slowdown interrupts the 14 years of expansion. We are on the blue marker, and I guess I don't need to explain this every time, but I use it as a framework, and I've put a bit more context into this slide and moving forward to show you how each sub-market perform as the 18-year land cycle plays out, also known as the business cycle. We are on the blue marker based off historical events in equivalent point of time, mid to late 2005. 18 months away from peak market, just like what happened in 2007, which we will then experience within the next 2 years, the next land-driven downturn, which will be like the 2008 GFC or the 91 recession we had to have, 1972, 1955, 1933 to 35 Great Depression. So every second one is a big one. So this time around, be prepared to protect yourself of the downside, but then also be in a position to capitalize on the opportunities, because this is really when the savvy investors take advantage of the downturns on all scales, not just the new starters, but institutional investors. There's a reason why Warren Buffett is sitting on over 300 billion in cash. He sees the writing on the wall. But I use this 18-year land cycle and or business cycle as a framework to work out which markets to get into and when to pull out of markets when they get too hot. And it is quite counterintuitive to what you see in the mainstream, what you see on the news, what you hear at the barbecues, because most people are getting excited over Brisbane, Perth, Adelaide, and their respective regions, and even the likes of, say, Darwin, as they are away at the races, which is a tendency towards the second half of the land market where people decentralize out of Sydney, Melbourne, and regional VIC, New South Wales, Tassie and Tasmania in their look for more affordable markets, which is when those second tier markets tend to run towards the tail end. But we are mainly focusing now on Sydney and Melbourne in preparation for the next growth cycle. So run through these future historical sales data, and I'll show you how you can use this framework and how I use the framework to best target areas from a macro level before we then deep dive into searching for deals on the ground. We'll start with Perth, and just a reminder, we are in a similar market to mid-late 2005, 2006. And as you can see, and as you are probably well aware, Perth units away at the races the last couple of years. And if we look back at history, as history doesn't repeat, but it sure rhymes, look what happened from 2005, 6, 7. Similar boom up until the peak of around 2007. But come 2008, the market switched off and went through this up and down protracted negative period. So we are no longer looking to buy into Perth for this exact reason. The markets typically go from trough to peak max 180%. And when you see, I guess, Perth units trough at around that 250 mark, now hitting over 500, it's already gone up 100%. So yes, it will have a little bit more juice left in the tank, but pretty much 20, 30, 40% would be the max. Once the market tops out, it'll lose probably half of that, the next growth over the next year or two, and then we'll go through a protracted, long, stagnant, flat to negative period. So not a market we're looking to buy into at this stage. Similar with Perth houses, have been away at the races in this certain suburb in Perth, came off a trough of just over 200,000 and has now, looks like it's topping out just over 550,000 medium value. So similar point in time back in history, had a solid run, and then once it started to top out, went through this negative subdued growth period for over 10 years. So this is why we are no longer looking to buy into Perth, even though Perth may look affordable compared to other markets like Sydney And Melbourne or Brisbane, it is not a market we're looking to get into because you'll most likely be left hanging for many years now if you continue to keep buying up in Perth based off the 18-year land cycle. I cannot stress this enough. Brisbane units still going strong. I personally own a couple of townhouse villas up in around Brisbane, looking to offload them in the coming year or so because I would rather sell out of a market once it tops out in, say, 2026, 27, than hold it through a stagnant flat period for many years at the same price point, because I could then sell down the asset, pay down debt, raise cash to reinvest into other markets that are set for growth runs. So Brisbane units, we were buying a lot up around 2018, 19, all the way through to around 2023. But once the boom starts to take off, that is when we no longer like to continue to enter into markets. We shift to adding value to our portfolios and get our clients to add value to their portfolios by way of renovation and or development. Great time to add value to your stock, but not to keep acquiring into markets that are going through the boom, because you'll overpay and be holding it for many years until the next growth cycle, which could be 10 to 15 years down the track. Similar story for Brisbane houses, looking like it's starting to lose some steam, but based off history, like what happened in 2005 to 7, had a little bit more growth. It does have the Olympic Games too coming into Brisbane, so Brisbane may get another final sugar hit, but that is not a reason to invest now into Brisbane. Brisbane has had its time in the sun. You need to get in before the market does the heavy lifting and not buy into markets solely because of infrastructure spend and Olympic Games. Sure, it's good, it's nice, gives it a final sugar hit. It's like the icing on the cake. But you need to be ahead of the game, ahead of the mainstream, and get into markets prior to the market doing the heavy lifting. Adelaide units looks like it has topped out in the recent month and will probably start this protracted, subdued period of next to no growth for the next, I'd say, 10 or 12 years until the later stages of the next 18-year land cycle. Similar to the houses, looks to be topping out, hitting its limit in 2025, and based off what happened 2005 and onwards, still had a little bit of growth, but more or less flattened out for a number of years. Sydney units, we have been buying in Sydney when the deals arise, but we have been patient on Sydney, not as active in Sydney as other markets. It has looked to have topped out of this last run in 2024, and I believe Sydney is starting to soften, like what happened in 2005, 6, and 7. It's due to soften out based off history. And then come 27, 28, 2027, 2028, when the mainstream herd finally realised that the Brisbane, Perth, Adelaides, Darwins and their respective regions have topped out and entered a downturn in 18 months to 2 years, that's when the demand will shift back to Sydney and Melbourne, as they have the most diversified economies, they got the most jobs, and they have been through this stagnant period in recent years. That's when the demand will come back to Sydney and Melbourne, and they'll then lead again out of the recovery of the next land-driven downturn. They'll call it something, the Trump tariff recession, I'm sure. Someone will get the blame. But that next downturn will set panic into the markets that are currently booming. They'll come off, go through a downturn, and then the ripple effect will come back into the likes of Sydney in certain pockets and in Melbourne, and then they'll then lead again, just like the bull run Sydney experienced between 2007 all the way up to 2017, a solid 10 years. So this is why we are now starting to sow our seeds in Sydney in certain pockets, in certain types of property, not every type of property. As you can see, houses still have a little way to go before they'll experience the growth cycle. I find during the downturns, there's a rush to affordable. So people can no longer afford the top end of town, the shiny houses, 2, 3, 4 million bucks for houses, whether if they have a big fat loan or they're renting it, they may lose their job. Everyone needs housing. There's a shift to the bottom end, and the bottom end always rises in a time of crisis because there's always demand for affordable stock, affordable rentals, affordable accommodation if they're buying it. So the bottom end rises when the top end's coming off. So the houses will be more subdued in the next downturn, along with the likes of commercial assets. Commercial will get hammered, as when you value a commercial property, it's valued based off its earnings. You derive back from the earnings to work out the price point you pay for a commercial asset. The trouble is when the business goes broke and there's no income, there's zero earnings, the commercial asset is pretty much worth land value. So that's when history shows us in the 2008-9 GFC, the 91 recession we had to have, 1972, 1955, 1933, and keep going back for 200 years studying these downturns. Commercial can get hammered by 50 to 70%, depending on the asset class. I mean, office space has been hammered the last couple of years. That stock is not going to recover for probably another 5 to 10 years, I'd say, until we come out of the next downturn. But the likes of shop fronts, retail space will all get a good slowdown in the times ahead if their business goes broke. Melbourne units is showing great signs of value and green shoots are starting, and we are actively buying in certain pockets, in certain types of property, both free market, off market, and on market. Sometimes it's always good to get an off market deal, but if the previous owner bought it peak market prior cycle and is selling at a loss, then sometimes they need to put it to market to get a dose of reality to understand what the actual fair market value is. So not all on off market deals are good. Sometimes they do need to go onto market, but majority of off markets, if they bought them 10 to 15, 20 years ago, you can get cracking deals. So get in touch if you want assistance getting a good deal. Houses are also showing good value, but are a little bit behind units in Melbourne based off historical sales data. Have a couple more years to soften out, but it's still a good time to enter in certain suburbs, in certain price points for houses, as you find the deals towards the tail end of their subdued growth when the confidence in the market is at its lowest. That's when you get the best deals, not when the market starts to pick up, because then you're fighting against every man and his dog trying to buy the property. By that point, we're on to the next market. So Hobart units are in a downturn from the peak of 2022, but looks to be stabilizing. And as of what happened in 2005-6, began to stabilize, but more or less went through a subdued flat period until around 2015, 2016, in the midpoint of the current cycle, when it took off, just like regional Victoria and regional New South Wales, when Hobart would have received the interstate migration from the likes of Melbourne once people got priced out of that market, once it was going through a boom. Same goes for houses in Hobart, had a solid run in the last few years from 2017 to 2021 as people left the likes of Sydney and Melbourne in their look for more affordable markets, but then topped out in 2021, 22, and went through a correction. Looks to have stabilized and based off history will more or less flatten out over the next 10 years until the next decentralization out of Melbourne in the next midpoint of the next 18-year land cycle. So there's definitely time on Hobart. Canberra, I'm not such a huge fan, but more or less same shape of growth pattern than some regional New South Wales towns. Units are very volatile, looks to be during the last GFC, so can be a combination of a lot of stock being released to market and going through a downturn, and then stabilized until around 2019, 2020, when it then took off, but has topped out as of 2022 and has looked to have started another protracted flat period. So, I mean, units in Canberra, not a super fan. I mean, there's also other technicalities down there of having to have a 99-year lease to the government. So that can also subdue growth. Not the best. There's definitely other markets you can invest in than Canberra, but thought I'd whack it in here just as a comparison. Houses are a little bit more stable, but again, looks to have topped out in 2022 and has started its protracted flat period. Probably will be a little bit more, not as subdued. We'll have a bit of buoyancy over the next couple of years before it will then experience a solid growth run like what happened from 2019 to 2022. But again, there's definitely other markets and even regional towns that you could put your money in that will perform better than Canberra. Darwin, I mean, this is when we just start getting silly. Thought I'd have to throw it in there because it's technically a capital city. But who knows? This could be anyone's guess. From 2005, 6, 7, we had a significant boom in the mining sector, which hence why you can see this solid growth run. And then come 2013, when the mine switched off, it then went through a significant downturn. Some people are getting excited and plowing in. Even some buyers agents are pushing people into that market, but not us, not for our liking. As you can see, it has started to come back, but it looks to have entered another downturn. So who knows? Could be anyone's guess. This market, you might as well go to the casino and play some roulette. It could go either way. It's got a very heavy dependency on the mining sector, and China is one of our main trading partners for our iron ore, coal, seeing gas and coal. However, China is not as economy is not as strong as what it was in 2005, 6, 7, 8, all the way. This big mining boom was thanks to China. They pretty much saved us through the GFC. This time round, China's economy is definitely not as strong, and they've got the US slapping them with tariffs left, right, and center. So this time around, their economy is weaker than back in 2007, 8, 9, and they've got a lot more pressure. So history doesn't necessarily always repeat, but it can rhyme. But as I said, this could be anyone's guess for units. Same goes for houses, very volatile market. When it's solely dependent on the mining sector, it can boom bust. So I don't know, you might as well go to the casino and play some blackjack or something. Get the same return and potentially double your money or lose all. So definitely not for us. It's not a very sustainable market to build long-term wealth, and even some banks don't necessarily like to lend in certain markets that are solely dependent or too dependent on the mining sector. So that can also make it challenging when it comes to financing. But this is a snapshot of where I see, or a summary snapshot of where I see all the capital cities as of 2025. As you are well aware, we've got Adelaide hitting its limits, has had a significant boom last couple of years. Brisbane, Perth, they're in the midst of the FOMO. All the punters, all the stupid money's pouring in with excitement and euphoria around the Olympic Games, but they should have got into that market 3 to 5 years ago. Darwin, similar story, is going through this bit of a explosion, FOMO, but he's anyone's guess, really. It could go either way. It's got too much of a dependency on that mining sector to really give any sustainable long-term growth. So could be in a boom, could be in a bust. Who really knows? Canberra, Hobart have had solid runs the last couple of years, have topped out in 2022, are now cooling, starting to stabilize, but still a good few years away before they'll bottom right out and then enter the next growth cycle. Sydney is probably between 18 months to 2 years from bottoming out, then starting its growth cycle. Melbourne is pretty much at the bottom. And depending on the price you pay and the suburb you buy into, you could be getting the deal of the century. So as always, this is by no means financial advice. Talk to your financial planner, your accountant, lawyer, mortgage broker, do whatever you're going to do. But if you want help buying an investment grade property and investing within the framework of the 18-year land cycle, this is the core of my investment strategy, is using the 18-year land cycle, studying prior events, moments in time, using them as pinpoints, as reference points to then overlay those events over many charts of historical sales data to best position and understand where a market sits currently and where it could be heading based off historical sales data and historical events. So if you want help, shoot me an email, like, subscribe, comment, share. Until next time, thanks for watching.